Marla Petrocelli's Honda Accord has 214,000 miles on it. It still starts every morning in her driveway outside Dayton, Ohio, and she still drives it to her shift at a distribution warehouse, and she has made a private decision that most of her neighbors have also quietly made without discussing it out loud. She is not going to replace it. Not this year, and maybe not for several more. The check engine light has come on twice in the last 6 months. Both times she paid to fix it rather than trade the car in, because when she priced a replacement, the monthly payment on almost anything on the lot was higher than her mortgage. That decision, repeated across tens of millions of households, has quietly produced one of the strangest numbers in the American economy right now. The average car or light truck on the road in this country is 12.8 years old. That is not a guess, and it is not a rounded estimate from a blog post. It comes from S&P Global Mobility, the firm that tracks vehicle registrations for the entire industry, and it is the highest average age ever recorded in the United States. Passenger cars specifically are even older, averaging 14.5 years. 10 years ago, that number was closer to 11.5. The American vehicle fleet has been aging for over a decade, but it crossed into territory in the last 2 years that even industry analysts did not expect to see this soon. This is not simply a story about people loving their old cars or about vehicles being built better than they used to be, although that part is true. This is a story about what happens when an essential, non-negotiable purchase, the kind of purchase that determines whether a person can get to work, get their children to school, or get to a doctor's appointment, quietly becomes unaffordable for a large share of a country that still considers itself middle class. It is a story about a decision millions of households are making that looks, on the surface, like patience. Underneath, for a significant number of them, it looks more like survival. To understand why the average car is nearly 13 years old, you first have to understand what a new car costs today, and more importantly, what it costs every single month for years afterward. The average transaction price for a new vehicle in the United States is now just over $50,000. That is not the price of a luxury vehicle. That is the average price of an ordinary new car, truck, or SUV rolling off a dealer lot. Sticker prices like that do not sit quietly. They translate directly into financing, and financing is where this story gets uncomfortable. In the fourth quarter of 2025, the average monthly payment for a new vehicle loan reached $767, according to Experian's State of the Automotive Finance Market report. Other trackers put the number slightly higher. Edmunds, which has been monitoring this closely for years, reported that nearly 1 in 5 new car buyers is now agreeing to a monthly payment of $1,000 or more. Not the total cost, not the price of the car. The monthly payment. 1 in 5 people walking out of a dealership today are committing to paying more for their car every month than many Americans pay in rent. To manage that number, buyers are doing something that would have seemed unusual a decade ago. They are stretching their loans out to lengths that used to be reserved for mortgages. More than 1 in 5 new car loans issued in the second quarter of 2025 carried a term of 84 months. That is 7 years of payments on a vehicle that, statistically, will have lost more than half its value before the loan is even paid off. Kelley Blue Book estimates depreciation losses on a typical new vehicle at up to 60% over the ownership period. In practice, this means a large share of new car buyers are now paying for years on an asset that is worth dramatically less than what they still owe on it, a position lenders call negative equity and drivers call being underwater. Down payments tell the rest of the story. In 2025, the average down payment on a new vehicle fell to around $6,000, down more than 9% from the year before, according to automotive news data. People are putting less money down on more expensive cars and stretching the remainder across longer loans, which is precisely the combination that produces higher total interest costs and higher monthly risk. It is the auto equivalent of what happened in housing in the years before the 2008 crash, except this time the asset depreciates instead of appreciating, which makes the arithmetic worse, not better. So people are opting out. Not out of car ownership, which is not really optional for most American households outside of a handful of dense cities with strong public transit. They are opting out of new car ownership, and in growing numbers, out of car replacement altogether. The scrappage rate, meaning the rate at which vehicles are permanently removed from the road, has held steady at around 4.5% for years. What has changed is the rate at which new vehicles are entering the fleet to replace them. New vehicle registrations only crossed back above 16 million units in 2024 for the first time since 2019, and even that recovery has not been enough to bring the average age back down, because so many vehicles that would once have been retired are instead being repaired and kept running. This is where the story shifts from a household decision to an industry transformation. As the fleet ages, an entire economy has grown up around keeping old cars alive rather than replacing them. The automotive aftermarket, the industry of independent repair shops, parts retailers, and service centers that keep aging vehicles on the road, is experiencing what its own analysts describe as a boom. Vehicles between 6 and 14 years old are now referred to inside the industry as the sweet spot, the range in which a car needs the most frequent paid maintenance but has not yet become so old that owners give up on it. More than 110 million vehicles, nearly 38% of everything on American roads, currently sit inside that window, and the share is projected to keep climbing through the end of this decade. For an independent mechanic in a town like Dayton, this has meant steady, even growing business. For the household bringing the car in, it has meant something else entirely. A car that would once have been traded in at year 8 or 9, right around the point when major components start to fail, is now being kept at year 12, 13, 14, which means it needs the kind of repairs that used to be rare. Transmissions, suspension components, air conditioning compressors, the parts that fail after 130,000 or 150,000 miles rather than the ones that fail after routine wear. These repairs are not small. A transmission repair alone can run anywhere from $2,000 to $5,000 depending on the vehicle, delivered as a single unavoidable bill to a household that has no line item in its budget for it. Consider a household built around what still looks, on paper, like a stable and even comfortable life. 2 incomes, combined earnings in the neighborhood of $90,000 a year, a modest 3-bedroom home with a mortgage locked in at a rate from several years ago, 2 children in public school. This household does not think of itself as financially fragile. It has never applied for public assistance and would likely bristle at the suggestion that it needs to. It has 1 car that is 9 years old and a second car that is 13. When the transmission goes on the older vehicle, there is no meaningful savings cushion to absorb a repair bill of that size, because the household's monthly obligations, the mortgage, the property tax escrow, the health insurance premium taken out of each paycheck, the 2 car insurance policies, already consume nearly everything coming in. The repair goes on a credit card. The credit card, at an interest rate now regularly exceeding 20%, becomes a new fixed monthly obligation that did not exist a month earlier. Nothing about this household's income changed. Its ceiling for absorbing an unplanned expense simply turned out to be lower than anyone in the house believed it was. This is the quiet mechanism running underneath the vehicle age statistic. It is not simply that new cars cost more. It is that the strategy millions of households have adopted to cope with that cost, which is to keep an old car running rather than finance a new one, comes with its own recurring bill, a bill that shows up unpredictably and in amounts that can undo months of careful budgeting in a single afternoon at the repair shop. And the repair bills themselves have been rising for reasons that have little to do with how a car is driven and everything to do with how a car is built. Modern vehicles, even modest ones, are now equipped with cameras, radar sensors, computer modules, and advanced safety systems that did not exist in mainstream vehicles 15 years ago. These systems make cars safer. They also make them dramatically more expensive to repair after even minor damage, because a bumper that once could be replaced for a few $100s might now house a sensor that requires recalibration by specialized equipment. CCC Intelligent Solutions, which tracks collision repair data across the industry, has documented what it calls increasingly complex, costlier, and technology-driven repairs, along with a rising rate of vehicles being declared total losses rather than repaired, because the cost of fixing them now exceeds their diminished value. For an owner trying to keep an older car alive specifically to avoid a new car payment, a fender bender that once would have been a minor inconvenience can now become the very event that forces the replacement they were trying to postpone. Layered on top of repair costs is a second, quieter expense that has grown even faster: insurance. Full coverage car insurance premiums rose by more than 30% between January 2023 and January 2025, according to Bankrate's tracking, adding roughly $625 a year to the average policy. Zoom out further and the number gets starker. Measured against consumer price index data, auto insurance premiums have climbed more than 50% over the past 5 years alone. This is not a cost tied to whether a driver has ever filed a claim. It is a structural cost increase driven by the same technology that makes repairs more expensive, by more frequent and severe accidents involving distracted driving, and by the rising price of replacement parts, which insurers pass directly onto policyholders in the form of higher premiums. For an owner who kept their old car specifically to save money, the insurance bill can climb regardless of that choice, quietly eating away at the savings the decision was supposed to produce. None of this falls evenly. A retired couple in a small Midwestern town, driving a paid-off 14-year-old sedan a few thousand miles a year to church and the grocery store, experiences vehicle aging very differently than a rideshare driver in Atlanta putting 40,000 miles a year on a similar aged car, or a construction worker in rural Texas who needs a reliable truck to reach job sites 40 minutes from the nearest town with no public transit alternative. For the retired couple, an aging car is a manageable inconvenience. For the worker who depends on the vehicle to earn income at all, an aging car is a business risk hiding inside a household expense, one that can eliminate an entire week's pay if it fails at the wrong moment. Geography compounds this in ways that rarely show up in national statistics. In states like Mississippi, Louisiana, and Georgia, auto loan delinquency rates near 8 to 10%, according to DeFi Solutions' analysis of TransUnion data, while in states like Utah and Washington, delinquency sits closer to 3%. The same national economic pressure, applied to different regional wage levels, different insurance markets, and different public transit alternatives, produces dramatically different outcomes for household stability. A car payment that is manageable in a metro area, with a $30 minimum wage differential and reliable transit backup, is a very different obligation in a rural county where the car is the only way to reach the nearest job, the nearest grocery store, and the nearest hospital, sometimes all more than half an hour away. This is where the story requires a genuine reframe, because the instinct is to treat an aging vehicle fleet purely as evidence of financial hardship, and that is not the complete picture. Vehicles genuinely are built better than they used to be. Engines commonly run past 200,000 miles with routine maintenance in a way that was far less reliable in the 1990s. Manufacturers have real incentive to build durability into vehicles now that the average ownership period has stretched so long, since customer loyalty is increasingly tied to how well a vehicle performs a decade after purchase, long after the original sale. Some of the households keeping their cars longer are doing so from a position of choice, not desperation, deliberately avoiding an unnecessary purchase, and putting the difference into savings or retirement accounts instead. But the honest reframe is not that everyone keeping an old car is thriving, nor that everyone is struggling. It is that the same behavior, keeping a car for 12 or 14 years instead of 6 or 7, has become the default for both groups simultaneously, for entirely different reasons, and from the outside those two households look identical. The neighbor with the 9-year-old sedan in the driveway might be sitting on a healthy investment portfolio and simply doesn't see the point of a new payment. Or they might be one transmission away from a credit card balance they cannot pay down. The car in the driveway no longer tells you which one you're looking at, and that ambiguity is itself part of what makes this moment strange. A behavior that used to signal frugality and a behavior that signals financial exposure have started to look exactly the same. What has changed most dramatically, and what connects this story to a much older set of anxieties about work and income, is the growing instability on the other side of the household ledger. What people actually earn, and how confident they can be that it will keep arriving. A car payment of $700 to $1,000 a month, stretched across 84 months, assumes a household income that remains essentially unchanged for 7 consecutive years. It assumes no layoff, no reduction in hours, no medical interruption, no divorce, no downturn in an industry exposed to automation or outsourcing. That assumption has always carried some risk. It carries measurably more risk now. VantageScore's analysis found that auto loan delinquencies have risen more than 50% over the past 15 years, and in 2025, for the first time, auto loans became statistically the riskiest form of consumer credit in the country, excluding student loans, surpassing even credit cards in the rate at which borrowers fall behind. J.D. Power's 2025 Financing Satisfaction Study found that nearly 29% of auto finance customers now qualify as financially vulnerable, a category defined not by low income alone, but by thin margins between what comes in and what goes out each month. This is the deeper layer underneath the vehicle age statistic, and it connects directly to why keeping an old car has become both a rational defense and, for many households, a source of quiet, constant stress rather than relief. A newer car under warranty carries predictable costs. An old car carries unpredictable ones. A household that chooses an older vehicle to avoid a fixed monthly payment it cannot guarantee for 7 years has, in effect, traded a known, stable cost for an unknown, irregular one, and psychologically those are very different burdens to carry. A fixed payment can be budgeted around, resented, but planned for. An unpredictable repair bill cannot be planned for in the same way. It arrives without warning, at the worst possible moment, and it requires an immediate decision. Pay it, finance it, or lose the ability to get to work tomorrow morning. For many households, there is no real third option. The car has to run. This dynamic plays out differently by generation. Older Americans, particularly retirees on fixed incomes from Social Security or pensions, often own their vehicles outright, having paid them off years earlier, which gives them one of the few genuinely stable line items in an otherwise unpredictable budget of rising healthcare and grocery costs. For them, an aging vehicle without a monthly payment is a source of relief, not stress, even as repair costs climb. Younger and middle-aged households carry a very different burden. Many are managing student loan payments, mortgage or elevated rent, childcare costs that in many metro areas now exceed $1,000 a month per child, and a car payment simultaneously, with none of those obligations paid off and no cushion between any of them. For this group, the 84-month loan is not really a 7-year commitment to a car. It is a 7-year bet that nothing else in their financial life goes wrong at the same time, placed by people who, statistically, are increasingly losing that bet. There is also a quieter psychological cost to all of this that rarely gets measured in industry reports, because it does not show up in delinquency data or average payment figures. It shows up in the small, private calculations households make every time they hear an unfamiliar sound from the engine, a rattle on the highway, a hesitation when the car starts on a cold morning. For a household with genuine financial margin, these sounds are an inconvenience, worth a call to the mechanic and little more. For a household running close to the edge, they become a source of quiet, ongoing dread, because the sound might mean nothing, or it might mean the beginning of a repair bill large enough to force a choice between the car and something else the family cannot go without. People in this position often describe driving an aging car the way they might describe managing a chronic health condition they haven't told anyone about. Manageable most days, but never fully out of mind, and always one bad appointment away from becoming an emergency. That quiet vigilance produces its own form of social withholding. Neighbors compare lawns, vacations, and home renovations openly, but they rarely compare the age of their vehicles or admit how carefully they are avoiding a trip to the dealership. A household earning a respectable income, with a car held together by a mechanic's careful patchwork of used parts, has little incentive to advertise that fact, because an aging car sitting in the driveway of an otherwise tidy home does not fit the image most people want to project. This is part of why the scale of the shift has been easy to underestimate. It is not hidden because it is rare. It is hidden because almost everyone doing it has quietly decided not to mention it. The decision also reshapes what households postpone elsewhere, because a car repair bill rarely arrives in isolation from the rest of a family's spending plan. A transmission repair in March can mean a canceled summer trip in July, not because the two are related in any obvious way, but because they draw from the same limited pool of discretionary income, and the repair simply arrived first. Dentists and optometrists report a similar pattern. Routine but non-urgent appointments get pushed back in the weeks and months following a major unplanned auto expense, as families quietly reprioritize which bills are truly unavoidable this month and which ones can wait one more. None of this shows up as a single dramatic event. It shows up as a slow erosion of the ordinary maintenance of a stable life, one deferred appointment and one canceled reservation at a time. There is a particular version of this story that plays out inside families, and it deserves its own attention because it rarely appears in economic coverage of vehicle affordability. Parents in their 50s and 60s, watching adult children struggle to afford a reliable car while working full-time, sometimes step in, co-signing a loan, gifting a used vehicle, or covering an insurance payment during a rough month. This help is rarely announced publicly and rarely discussed at family gatherings, because both sides tend to feel a quiet discomfort about it, the parent worried about their own retirement runway, The adult child embarrassed to need assistance for something as basic as transportation to a job. A parent who co-signs an auto loan for a child is also taking on legal responsibility for that debt, a fact that surprises some co-signers only when a missed payment shows up on their own credit report years later. This is not a dramatic collapse. It is a quiet redistribution of financial risk within families. One more obligation moving from a struggling younger household onto an older one that may have very little room to absorb it. The used car market, which might seem like the obvious escape valve for households priced out of new vehicles, has not provided the relief many expected. Used car prices surged during the pandemic-era supply shortages and have never fully returned to their earlier baseline. Average monthly payments on used vehicles now run around $531 to $537, according to Experian's most recent data, a payment that, while lower than a new car, is still a substantial monthly obligation for a vehicle that offers none of the reliability guarantees of something purchased new. Interest rates on used car loans are also dramatically higher than on new ones, averaging over 11% in recent data compared to roughly 6.5% for new vehicle loans, because lenders view used vehicle collateral as riskier. For a deep subprime borrower, meaning someone with significantly damaged credit, the average rate on a used car loan has approached 22%, a level at which the total interest paid over the life of the loan can rival the price of the car itself. New tariff policy has added further pressure, with industry analysts projecting that tariffs on imported vehicles and parts could push new car prices up by $3,000 to as much as $10,000, a shift that would, in turn, push even more buyers toward an already strained used car market and drive used prices higher still. There is no version of this story that ends with a simple fix, and a documentary channel does a disservice to its viewers by pretending otherwise. Some responses genuinely help. Buying a certified pre-owned vehicle, typically 3 to 5 years old, splits the difference between new car reliability and used car pricing, and remains one of the more rational paths for a household that needs dependable transportation without a 7-year commitment. Credit unions frequently offer meaningfully lower auto loan rates than banks or dealership financing, and shopping a loan separately from the dealership rather than accepting whatever financing the sales floor offers can save thousands of dollars over the life of a loan. Building even a small dedicated repair fund, separate from a general emergency fund, gives a household a chance to absorb a moderate repair bill without reaching for a credit card, though this requires margin that many households, stretched between rent, food, and existing debt, simply do not have to spare. None of these responses solves the structural problem, which is that new vehicle prices have risen faster than wages for the households that need them most, and that the vehicles keeping the country moving are, on average, older than they have ever been in recorded history. A shorter loan term helps an individual buyer avoid negative equity, but it does nothing to lower the sticker price that made a long loan necessary in the first place. A repair fund helps a household absorb one unexpected bill, but it does not change the fact that a 14-year-old car will need more of those bills, more often, than a 5-year-old one. Every adaptation available to an individual household is a way of managing risk that the broader market has shifted onto them, not a way of eliminating that risk. What this reveals, ultimately, is not a story about cars at all. It is a story about what happens when a basic requirement of American life, in a country built almost entirely around the assumption that most people will drive to work, quietly outpaces what a working household can reliably afford to replace on a predictable schedule. For most of the 20th century, trading in a car every 5 or 6 years was simply what a stable household did, a small, unremarkable ritual of middle-class life. That ritual has not disappeared because Americans decided cars were unimportant. It has disappeared because the math stopped working for enough people that the entire market shifted underneath everyone, including the households who could still comfortably afford a new car every few years, but now find themselves surrounded by a used and aging market shaped by everyone else's constraints. There is a wider economic ripple that extends beyond any single household's driveway, and it helps explain why this trend matters even to people whose own vehicles are new and paid off without difficulty. When a large share of the population delays a vehicle purchase for 2, 3, or 4 extra years, that delay removes billions of dollars in economic activity that dealerships, manufacturers, and the towns built around them once relied on. Franchise dealerships in small and mid-sized cities employ mechanics, salespeople, finance staff, and detailers, and their revenue depends heavily on turnover, on people trading in a 6-year-old car rather than nursing it toward its 15th birthday. When that turnover slows, so does hiring, showroom investment, and the tax revenue some municipalities collect from vehicle sales. At the same time, the aftermarket repair economy grows to absorb the difference, shifting jobs and revenue from new car sales floors toward independent garages and parts suppliers, rather than eliminating that economic activity outright. It is less a story of an industry shrinking than an industry rearranging itself around a customer base with less capacity to buy new. And that rearrangement has its own winners and losers in local economies across the country. It is worth being honest, too, about where this trend does not apply evenly, because treating every American as equally squeezed by car costs would flatten a genuinely more complicated picture. Higher-income households, including many who could easily afford a new vehicle every few years, are also choosing to hold on to cars longer, driven partly by better vehicle durability and partly by a broader cultural shift away from treating a car as a status marker that needs regular updating. For this group, an older car in the driveway is a rational choice made from strength, not constraint, and lumping their decision in with a family stretching a 14-year-old sedan to avoid a loan they cannot safely take on would be a distortion of what is actually happening. The honest conclusion is not that every aging car represents hardship. It is that hardship and prudence have converged on the same visible behavior at the same moment for reasons that have almost nothing to do with each other, which is precisely why the vehicle age statistic on its own tells you so little about the household behind any individual car. The number will keep climbing for a while yet. S&P Global Mobility's own analysts expect the share of vehicles in that 6 to 14-year sweet spot to reach 40% of the fleet by 2028, and nothing in new vehicle pricing or interest rate trends suggests that arc is about to reverse. Somewhere out there tonight, a check engine light is turning on in a driveway much like Marla Petrocelli's, in a car that has already outlived every reasonable expectation anyone had for it when it was purchased. The owner will look at the dashboard, do the math they already know by heart, and decide again that it is still cheaper to keep going than to start over. That decision, repeated in millions of driveways across the country, is not a sign that Americans have simply gotten wiser about cars. It is a sign of what an entire generation has quietly agreed to live with, one more repair bill at a time.